Hi everyone, so today I'm going to be covering Alight. It's going to be a stock analysis video, so let's get right into it. So if we take a look here, what they do as a company, they're a technology company that provides cloud-based integration for digital human capital. And pretty much they manage health, wealth, retirement, different type of accounts for the Fortune 100 companies. So integrated benefits, administration, health, retirement, leave of absence, financial well-being, payroll services, anything with retirement as well, and anything with HR needs. They're in 70% of the Fortune 100 companies, so pretty easy business to understand, I would say, overall. But something to be cautious of is the earnings. Now, if we take a look at the Q 2025 highlights, this came out August 5th, so this is the most recent quarter. The revenue was a decrease of 1.9% from the year prior. It was $528 million, which obviously not great. Now, if we take a look here, Q2 25 results were mixed. The adjusted EPS meetings expectation improved adjusted EBITDA, but a significant gap loss due to the goodwill impairment charge. The decline in project revenue and extended deal closure times impacted the full year guidance. Alight is focusing on strategic initiatives like AI and expanding partnerships. The market reacted negatively and the stock declining. So again, not great. And here's more of a specific to see the metrics and things like that. So now, if we look at the expectations, that was the EPS was 10 cents. That was in line with analyst expectations. Revenue slightly exceeded. They beat on that. It came in at $528 million for the quarter. The estimate was $525 million for analysts. It did miss expectations on GAAP EPS, which was negative $2.03, significantly below the consensus estimate of negative 7 cents. That was the goodwill impairment charge again, so keep in mind. And they had to lower their full year guidance for 2025. So, of course, analysts don't like that. The stock sold off significantly as a result. Now, I wanted to point out, though, that the good news is they have something called backlog growth. And in the videos that I previously done with Indie Semiconductor, with Abe, they have a thing called backlog growth, which are guaranteed contracts. So they have guaranteed contracts with different companies. And in this particular case, for Alight, they have $3 billion in revenue under contract, which is good to see. Right? So there is a guaranteed revenue stream going on here, as we can see here. So now let's take a look at the financials and see what's going on. The financials, the free cash flow doesn't look great. 2020, 143 million, now 142 million. It hasn't moved anywhere. It just lost $1 million from a couple of years ago, for 5 years ago about. So not great with that. If we check simply Wall Street, which I'm going to pull out now, a little bit better. Their free cash flow, 142 million, like I mentioned, and it will be 376 million. So that's a little bit more than a double, and I think that's going to be good. Eventually, earnings will be positive, so that's great to see as well. The financial health, though, could use a lot of work. I don't like this picture. The equity is declining. The debt is pretty stable. Well, it's declining a bit, and the cash is a lot lower than the debt. I don't love that picture. And as you could see here on the red X's, you could see why that their net debt to equity ratio is considered high. Their short-term assets do not cover long-term liabilities. So you have to be a little bit cautious with that. Now, if we check my DCF is actually going to say it's undervalued 54%. If you use historical growth, that was historical growth. You use Wall Street to be 68% undervalued. So really, however you look at it, it's going to be undervalued. But it's not growing that fast. The revenue is my only concern. It decreased 2% from last year. So it's not, and the earnings aren't that great. So I'm a little bit cautious with it in general. Now, if we check Tipranks for it, which I got to load super quickly, it's excellent. It's 3 buys. And let me load it again because it's fast. It's about 70% upside on the stock right now. So in that sense, it's good, but I think what I'm going to do is I'm going to cover for Q3, and we're going to see if there's any improvement, because I'm a little bit cautious about the decrease in revenue and then the lowering of targets from the owned company too, the guidance. So I'm a little bit cautious with this one, but it does look pretty good. Thank you, everyone.